what we've done is we've added a couple things to the accounting cycle. So this is the accounting cycle. So just as before, we're going to start with a business transaction. And again, that's something that will change the accounting equation. And it produces a source document, which is just a written, which is a written proof that the transaction occurred. Then we journalize that. And of course the journal, it pairs the debit with the corresponding credit, and then the explanation on the job will refer back to the source document. In here, they're just kind of perfunctory, right? They just want you to know if there is such a thing, okay? Then you post to the ledger. And then what you do is the very first thing at the end of the accounting period is you do a trial balance. And you make sure that and then trial balance is the ending balance in all your ledger accounts. You verify that the debits equal the credits. When they do equal, you have a lot of assurances that everything was done correctly. It's much more powerful than it looks. And if they don't equal, you know there's an error and find it before you go any further. Okay? Then, but some of these need to be updated. So then we do the adjustments. And of course we journalize and post them to the ledger. Then we take this ledger and we do another trial balance. And so after we do the adjustments, we journalize, we post them to the ledger. The name for this is the adjusted trial balance. So the adjusted trial balance is the one after the adjustments. So if the adjusted trial balance is after the adjustments, what do you think they call the one before the adjustments? The unadjusted trial balance. So this is the one we've been working with. This is what we've added. Now that you have these accounts that are current, then from this is the one, because all the accounts are current, this is the one where you produce your financial statements. Okay? And just because they're current. All right? How you doing? Everybody got the roll? All right. So I'll put this up here. All right. Where is everybody?
There's an accident on 14.
Oh, was that the deal?
Yeah, there's a guy that's turned around in the opposite lane.
Oh, really?
Yeah.
Oh, okay.
So you might get some stragglers coming.
Okay. All right, because 14 will do it. All right, that's good. Well, let's take a look here. So what we've added is we've added the adjustments, the adjusted trial balance. This is what we've added this quarter. Okay? Now, let's take, and again, what we're doing at this point in time is we're doing an overview. So I get, so now let me get my thing here. Let me get this. I'm going to turn this forward. And again, I'll put these on in Moodle. Now, again, we're doing an overview. So I'm going to turn out this light so that it's more readable. Okay. So this is from page 105. I know that's kind of dark, but this should work okay on this thing. So this is from page 105. I'll write that up here under the lighted area. And here's kind of an overview of what happens with the adjustments. Okay? So, prepaid expenses. Now this prepaid expenses are the things like, you buy the insurance in advance, you buy your supplies in advance, you buy a car. Those are what we call prepaid expenses, right? So these assets are the same as paying for an advance and paying for an expense in advance. Then when they're used up, you convert them into an expense, right? Mm-hmm. All right, so before the adjustment, here's what happens, is your asset is overstated. Some of it's been used up. the car wore out, the supplies were used up, the insurance expired, right? And the equity is understated, and the reason, the equity is overstated. The reason the equity is overstated is because the expenses haven't been declared, because expenses decrease equity. The income statement is the expenses are understated on the income statement. The adjusting entries should debit the expense, supplies expense, insurance expense, depreciation expense, and credit the asset. You want to go ahead and sign in on your way by there, and thanks. Okay? And so you debit the expense and credit the asset. Now, when I say credit the asset, depreciation is an exception to that. Okay, in depreciation, you credit the contra asset. And the reason is it's an estimation. Now, unearned revenues. Now, unearned revenues, of course, is when you get a prepayment. Okay? And when you get a prepayment, you debit cash and credit unearned revenues. It's a liability, it's unearned. Now, before the adjustment, liabilities are overstated and equity is understated. So then what happens, and the reason equity is understated is revenue is understated. So in other words, the liability is really less than you have on your balance sheet because some of it's been earned. And your equity is understated because you don't recognize the revenue that you've earned, okay, and your revenue is understated. The adjusting entries, you debit unearned revenue and credit revenue. So you're converting the liability into revenue because you've earned it and you don't owe it. Okay? The next one are accrued expenses. Now accrued expenses are things like wages expense, interest expense, okay? That's an example of accrued wages, okay? Accrued expenses. Now, before the adjustment, don't forget, you put wages expense and then wages payable, right? And so the wages payable isn't included in the balance sheet, so liabilities are understated. Equity is overstated because you haven't declared the expense. The adjusting entries, you debit expense, wages expense, and you credit the liability, wages payable. Okay? Then, the last one are accrued revenues, and this was like the dam. So what it is you're going to be paid when the project's completed, right? So, but for your income, for your financial statements to make sense, you have to estimate how much you've earned in each accounting period. So you estimate how much was earned. If you don't do that adjustment, then the assets are understated because you've earned some money and there'll be some sort of a receivable, right? And your equity is understated because you haven't declared your revenue and your revenue is understated. The adjusting entries, you debit an account, some sort of a receivable because you're due the money, and you credit revenue because you've earned it. Does that make sense? Kind of an overview. All right. Now, let's do one more kind of overview sort of thing before we kind of move on here. So back here, what we have here now is we talked about doing the unadjusted trial balance, making the adjustments, doing the adjusted trial balance, and doing the financial statements. Here's where you do them. You do in something called a worksheet. So, this is what the worksheet looks like. And we'll get into this worksheet, in Chapter 4. So what you do here is it's like an Excel spreadsheet. So what you do is, here's the unadjusted trial balance, here's all your accounts, here's the ending balance. You make sure the debits equal the credits. This is where you do the unadjusted trial balance, and that's this one right here. The next is the adjustments. Here's where you calculate the adjustments. So here's the next step in that. So now, here's the unadjusted trial balance we just did. Here's the adjustments. So for instance, on this one, accounts receivable is increased by $1,800 in debit. And down here you have consulting revenue. So this is one of those where you're going to be paid when the job is completed. And at the end of this accounting period, you say, listen, I earned $1,800 on this thing, right? So this is where the adjustments go. The next one down, supplies are credited for $1,050 because that's the amount you've used. And supplies expense, which is down here, is debited. So this is where you actually calculate the adjustments. Yeah, Michael?
Daniel.
Denny?
Denny? What?
You said Denny?
Daniel.
Daniel. Oh, okay, that's right. Never mind, Daniel. Okay, thank you.
And so you only have to do the adjustments if the first unadjusted trial balance does not balance out.
No, what you do, pretty close, but here's the deal. Don't forget the trial balance, it is a financial statement, but what's different about it, its purpose is to check the accuracy of your accounting.
Okay.
Hi, Serene, could you sign in your way by there in the corner? So Daniel, here's the deal. What it is at the end of every accounting period, you say, how accurate was I? So what you do is you go to your ledger, list all the ending balances, that's called the trial balance, and you verify the debits equal to credits. And so in effect, now what we have here are two trial balances,
Right.
right? Now there'll be a third one coming up, the post-closing trial balance. So in effect, now let me just kind of expand on this. What it is have you wondered why in the world are we writing the same number twice? Okay. Okay. And you think, doesn't that like double our effort? Okay. That, how dumb? Who thought that? Here's the deal. There are single entry bookkeeping systems, like your check register is single entry, right? So on this thing, what happens in this is, how do you check your accuracy? You do a trial balance, and I think the secret to understanding this is it's so much more powerful than you'd think. It appears kind of simple, right? All right. Hi. Candy, could you sign in on your way by? Okay. So what you do is you do a trial balance, and its purpose is just to check the accuracy. Okay. And, let me go back to that check. So here's the deal. On your check register, how do you know if you made an error? Well, what you gotta do is you gotta go back and just check every figure as you go along, right? Here, you do a trial balance, a fraction of the work. And this will tell you its accuracy, and that's why you do the double entry bookkeeping system, is it enables you to check things as you go along quickly and with a lot of assurance. No guarantees, so, obviously it won't catch everything, because if you forgot a whole transaction of both the debit and the credit, they'll still equal. Or if you put in something twice, they'll still equal.
Right.
Or instead of debiting cash, you debited accounts receivable, it'll still equal. But it will catch almost everything you can catch. And then there are ancillary checks that will catch the things that a trial balance won't catch.
Okay.
Okay.
Perfect.
Now you're thinking I'll never ask again.
Yep.
Yeah.
Thank you, though.
I just didn't want that much information. Okay, well, all right,
No,
never
that's
mind.
good, thank you.
Okay, sure, all right. Well, listen, I'll be less long-winded in the future because I don't want to, these questions are appreciated. Okay, so I won't, okay. Well, here you go. So now, the next step, here's the adjusted trial balance. So what we're going to do with this is we're going to combine the adjustments with the unadjusted trial balance. So in this case, supplies started out at $9,720. 1,050 was used up, and now we have 8,670 on hand. And that's the adjusted trial balance, that's this thing right here. And then on the same financial on the same worksheet, the columns aren't shown here, but we'll then do our financial statements. We'll start with the income statement and then the others. Okay? And we'll start that, this is Tuesday, Thursday, we'll start that Tuesday. Okay? All right, so with that introduction, let me take this down. Now, I want to spend today practicing, so why don't we finish all the topics, and then we'll go as far as we can, okay? Now, the ratio, well here, and actually, while this is on the board, now, here is Clark College is in this consortium, and etutoring.org. If you guys have a question that's just too long for an email, these guys will, this is an online tutoring service. And by the way, if you go to Moodle, at the top of the Moodle page, they have tutoring. If you click on that link, it'll take you to the same place. Okay, so in Moodle, it's in the upper right-hand corner. And so I know it's 7 days a week. I don't know if it's 24 hours a day, but it is 7 days a week. So if you have a question, if you're lost on like a Friday or a Saturday or Sunday, here you can get some answers here. Okay. All right. Now let's do one more. I'm going to get past you. Thanks. Let's do one more of these. Let's do the ratio that's in this chapter. turn on the light here. And then, we'll see if we can clear up any questions. So the ratio in this chapter is the profit margin. Okay? And what it is it's net income divided by net sales. Now, net sales is a term we haven't used yet, but what it is revenue. So on an income statement, you have revenue minus expense equals net income. So this revenue is net sales, and of course net income is net income. Now, why is net sales and revenue, why are they different? Well, instead of calling this revenue, let's just call it sales. They're interchangeable. Okay, and sales is an account name that's used for revenue. And the reason it's net sales is you have sales minus some things like sales returns. Now this is the one that's easy to see, but there's other ones that are included in here too. That equals net sales. So sales is what you sell. Sales returns are what your customers bring back. Now, if your customers bring it back, is it a sale? I don't think so. So net sales is the real sales. Okay, so sales really is the revenue account. You sell something, you debit cash, credit, sales, just like you would have credited revenue. Sales is the name of a revenue account. And then you subtract what comes back, and that gives you net sales. So that's this net sales here. Okay, and of course, when your customers bring it back, that's not a sale. Okay, so this is like real sales, and this is the actual gross sales. Okay? So in this case, you went to the income statement, and you found that the net sales was $40,000, and that the net sales were $100,000. This came out to be 0.4 or 4.4 or 40%. Now, what does this tell you? Well, it tells you a number of things. First of all, what it says is, every time, suppose you have a small business, every time you sell one of your customers something for $1, 40 cents goes in your pocket. Always kind of nice to know. The other thing it does is, it's very possible for your expenses to creep out of line. So what happens is, we're all used to things going up, right? Happens all the time. A little here, a little here. So it's very possible to have great sales and not have any net income. So you can just make sure that everything is copacetic, is as you expect it to be, okay? Because it's so easy for, if you don't watch these things, it's easy for them to creep out of line, okay? So that's the sort of thing that the profit margin will tell you. It does tell you the percent that goes in your pocket of gross sales, and it also enables you to keep track of things so that you don't end up increasing your expenses, not increasing your sales, or not increasing at the same rate and lowering your net income. And that's what it does. All right. Okay, that looks like the chapter. What questions are there? Any? Well, let's do some practice here then. So let me, and I'm just going to ask people to sit together, form a team, and let's do this. All right. You guys want to be a team? Okay, there you are. All right, here you go. You guys want to be a team? All right, let me. Somebody's going to join us. You guys, there you are. Okay. You guys want to be a team? Here you are. You guys want to be a team? All right, there you are. Put it between them. guys want to be a team? All right. You guys want to be a team? Sure. I'll put it between you. Okay. Daniel, let's see. You're going to move up there. All right. You guys want to be a team? I'll put it between you. Okay. Oh, was it? Well, then you were just putting the fixed chair. You weren't. All right. Here you go. You guys want to be a team? Well, there's a third person here, right?
Game.
All right. How about this?
Sure.
Let's see, what do we got? We got this guy's here, and that'll be 2, 4. How about this? It works better with 2 people. It's sometimes the third people. You guys want to be a team? Sound good? And actually want to join the gym? Okay. Here you go. You guys want to be a team? Sure. All right, sounds good. So, let's not do the first page. Well, here, let me just show you how this works. So what it is this is problem 3-3B, right? And problem 3-3B. Put it for you here. So what it will ask you to do is on page 129. Now, I'm going to turn that forward. Let me get past you, thank you. Turn this forward. All right. So what it will ask you to do, I'll make that more readable, but I'll turn the lights back on when we're ready to get to work. So let's start here. And I think this is how we can make the best use of our time. So, let's start, let's start on the second page, which is this one right here, it's the journal. And what it will ask you to do, now by the way, part of the way through, I'm going to interrupt to show you something on 3-1A that I think will make it a more rewarding experiment. So I will stop you halfway through just because I want to explain something to you, okay? But let's start here. So what we have here now is, it'll ask you to make these adjustments. So what it is this is the unadjusted trial balance. Here are the adjustments. So, an analysis of the Institute insurance policy shows that 6,400 coverage has expired. Man, you guys are smarter than this. I don't know why they dumb it down for you, because they tell you how much has expired. Well, that's a simple one. And of course, what you do on this thing is, hi. Could you sign the roll on your way by? Thanks. It's up here in the corner. So in this, of course, what you'll do is you'll debit insurance expense, credit prepaid insurance. So be sure to use these account names, right? Now, then, when you do all the adjustments, what you do is you go back to the front page, the ledger accounts. And you start by entering these balances in the accounts. Then you adjust them with these adjustments. And then you use the ending balances to do the adjusted trial balance. And then the financial statements. Does that sound pretty good? All right, so let's start with the journal. And again, I'll stop you part of the way through, and I want to explain something from the other homework problem. Your homework is 3-3A, and when you learn it in here and do it again, you can take it the next step. You'll see things that you didn't see before. It'll be a richer experience. Okay? Hi, let's see. All right, is everybody doing good? Now, oh, by the way, I wander around. The reason I do that is because if I stay here, often people don't ask a question. But if I'm handy, or if I check in, they ask questions. So I'm just trying to make the best use of our class time when I do that. I'm not checking up on you or anything. It's just how to do that. All right. Okay. Let's see. This guy's coming back, so there's 2 of you. All right. Hey, how you doing back here? Would you join up that? Whatever group you like. So, let me finish. You guys would be enjoying it? All right.
Okay.
It started
Can
off
you do that?
debit, now we credit that debit.
Or actually, no.
Daniel, you right with you, Daniel? Let me,
Oh, yeah.
and you're okay, if you're okay with this?
Okay, insurance expenses.
No.
Yeah, I know you
The adjustments. So you see that?
I don't know, I'm 100%.
Here's where you do the adjustments. And here's where you do the unadjustments. So for instance, cash, you'll have a debit of 50,000. And no, I'm sorry, do this one first. And so then I hope we'll give you a good answer here. So what do you do? Let's just start with this account.
That'd be a good one. Okay.
Then, you put the beginning balances in the ledger, and you find the beginning balance here. Post the adjustments here. And then, the ending balance adjusted.
Okay, okay, I see. Yeah.
All right. And by the way,
And then when we go back to the trial balance, we'll subtract the asset.
here you are. You're all set, ready to go.
We're just a little confused on where to start.
Right here. And I'm very glad you asked, DJ. So the
When you go
analysis
back in the spreadsheet, you're gonna make an adjustment.
So we have an insurance expense.
Does that mean we still,
Hey, you guys, let me put the first one in here for you. Okay, so on the first one, I'll turn this around, I'll turn those lights on in just a second too. So let me do the first one. Oh, it's already set there. So the first one then, what it says is, it says, the analysis of it shows that 6,400 of the coverage has been expired, right? So what you want to do is you want to use the account names that are here. So let's go down here. So it's insurance expense is the account that I'll use. I'll make this large as I can. Okay. So what you want to do is you do the insurance expense, that'll be the debit. So as far as the date goes, and by the way, can I have your attention, you guys? Thanks. The date will be A. Okay, here's where I'm getting at. Insurance expense will be debited. And I'm right, EXP for expense. It'll be debited for 6,400. And let's look at prepaid insurance is the asset account name. And it'll be credited for 6,400. Now on adjustments, often above the first entry here, okay, you just have the word adjustments. Okay, and that's usually the only explanation that's needed. So is everybody okay with that? And listen, why don't you guys do the next one? So the inventory account shows that teaching supplies costing 2,500 are available at the end of the year. So that's the ending, right? So this up here, teaching supplies, the 60,000 is the total amount you purchased. The 2,500 is what you have left. How do you calculate how much is used, and what do you do with that adjustment? Does that sound good? Daniel, how you doing over there? Did I give you a good answer?
I'm good, I think so.
You're doing good?
Yeah,
All right.
I'll ask you questions.
And I'll put up the answers as we go along.
So,
So you just, would you just debit 20,000 and then credit teaching supplies? Here's an analysis here. Teaching supplies. So put that on the expense.
Oh, yeah. That makes her match.
so
You
how
can-
much
Depreciation expense.
Okay.
Well, I think it's this one first.
Now here is the entry, here's the journal entry for B. By the way, guys, I used A, but here's where they got the December 31st.
Don't worry, just put it right here at the end. Oh, okay.
Now, if you guys are okay with that, turn the lights on.
So annual depreciation, so it'd be, which one was first?
It's gonna be expense first, assessment, losing $4,000.